So Malou, thank you very much for joining me on Global Tax Org. It's great to have you here.
Thank you so much, Will.
Good. So let me talk a little about the OECD. The Philippines joined the OECD Inclusive Framework last year, and but that country is home to only a few ultimate parent entities who would actually be affected by Pillar 1 or by Pillar 2. Nevertheless, in December, the country introduced a digital services tax, a 1% withholding, applicable to 1/2 of the gross remittances of electronic marketplace operators and digital financial services providers to the sellers or merchants for the goods or services sold through their platform. So how are companies dealing with the resulting compliance burden, and what other changes would you expect in the Philippines with respect to investment incentives, in particular tax incentives and the overall tax regime, in the light of what's happening with Pillar 2?
So to clarify, the 1% withholding tax on 1/2 of the gross remittance by e-marketplace operators and digital financial services providers is not a digital services tax per se.
Okay.
So it is not imposed on the income of these digital service providers, but they are designated as the withholding agent on the income payment to sellers and merchants of goods and services through their platform and facility. So the online sellers and merchants, they were required to register their business with the Bureau of Internal Revenue, or BIR, and submit their certificate of registration before they can use the facility of this DFSP. The e-marketplace actually operators and the DFSPs are allowed a period of like 90 days from the date of issuance of the regulation, or to comply with the relative policies or requirements of other government agencies, and to give them opportunity to comply with the new requirements. So far, I think it's still ongoing.
Mm-hmm.
So there is, however, a pending legislation imposing VAT on foreign service providers of digital services to consumers. And the House bill has already been approved by the lower house, but its counterpart bill in the Senate, it's still being routed for approval at the Senate Committee on Ways and Means. However, ahead of this VAT on digital services, the BIR recently issued Revenue Memorandum Circular 5/2024, wherein the BIR says that the cross-border transactions follow the benefit received theory, where payments to non-residents for services, even if not performed in the Philippines, may still be subject to the final withholding tax and 12% final withholding VAT if the benefits from such services will be derived in the Philippines. Well, the BIR actually explained that this is more of a clarification, and the treatment is made in the Supreme Court's recent decision on the taxation of satellite airtime fees paid to a non-resident foreign corporation, where we call it the ACES case. Well, the Supreme Court held that the income shall be subject to final withholding tax since it accrues only upon delivery of the satellite airtime and when it is already utilized by the Philippine subscribers. So the RMC provides that the source of income is in the Philippines if the property, activity, or service that produces the income is in the Philippines. It is not necessarily determined by the location where the payment is disbursed or physically received, but rather the location where the underlying business activities that produce the income actually took place. Right now, business and professional organizations submitted a consolidated position paper to the Commissioner of Internal Revenue requesting for a reconsideration of this RMC. On the Pillar 2 side, well, as you mentioned, the Philippines is joined the inclusive framework, and it actually assumed the chairmanship of the Intergovernmental Group of 24 this year. And on that, it cements the Philippines' position as a champion to developing countries in international tax discussions. And building on the reform principles agreed upon in the inclusive framework, developing countries need to formulate and implement tax measures, including withholding taxes on digital and remote transactions involving their residents, or to configure a significant taxable economic presence in their jurisdiction to protect their tax base in ways that are tailored to their unique circumstances. So this will entail stronger and more inclusive multilateral cooperation to reach a fairer and more stable international corporate tax system. Okay. On the qualified domestic top-up tax, Well, this is expected to be widely used and implemented by developing economies such as the Philippines because it gives first dibs to the host country over the country of the parent company. So in our case, if the QDMTT is adopted in the Philippines, the tax authorities would be able to collect at 15% of the global minimum tax from registered entities with the incentive giving bodies like the PEZA or the Philippine Export Economic Zone Authority, wherein they are under the income tax holiday instead of the country of the parent getting it under the other framework.
Thank you very much for that, Malou. That was very comprehensive and I think very enlightening for our listeners. Let me talk about one other thing in relation to sustainability. So the Philippines continues to prioritize transparency as well as sustainability, R&D, e-invoicing, and requires real-time data transfers to the government. Which is starting in 2024, and the Philippines continues to use a tier system to provide tax incentives for investments in areas such as green ecosystems and digital innovation. So again, given what's happening with Pillar 2 and a whole range of other things, what changes may be on the horizon and what should companies look out for in the coming year?
Okay. So basically at the outset, the government the Bureau of Internal Revenue adopted a 10-year digital transformation program or roadmap. This is from 2020 to 2030. And as of 2022, I understand that 14 out of the 49 projects in phase 1 have already been launched or implemented. Among these digital projects, it includes the BIR's, what we call the integrated system, or an acronym of IRIS, which serves as the Bureau's central tool and repository to process taxpayer information, and the Enhanced Revenue Stamps Integrated System, which basically is an application that manages the ordering, production, tracking of revenue stamps to monitor the payment of excise taxes of tobacco products. Yeah. This is the first part of the. This is part of the first phase of this roadmap. While the EIS is launched, it's progressing maybe slowly, but this is due to the performance issues with regard to the platform. But we can expect mass adoption of the electronic invoices, as you've mentioned, as large taxpayers transition to this electronic model. As this will be extended to all major taxpayers, this year we expect the BIR to issue the proper guidelines on compliance and non-compliance of this mandate. Also, the Commissioner of Internal Revenue announced that the Asian Development Bank approved a $400 million loan to help the efforts of the Philippines and the BIR to modernize tax administration systems and processes. And among the reforms pursued by the government is in line with the DRM, or the Data Rights Management Program, which is the Digital Transformation Initiative of the Bureau. And it aims to modernize key taxpayer services, including online tax registration, returns filing, and payment. And based on this roadmap, the BIR is planning to adopt integrated systems and automatic exchange of information to launch a platform for digital economy taxation. It was also envisioned to align tax rules and regulations to capture digital economy taxation that must be consistent with the digitalization program until 2026. And so far as the developments in the Philippines are concerned, well, attracting investment is first would be one, the ease of paying taxes law. This was just passed, or this just became effective in January. This is a welcome development to modernize tax administration and improve efficiency by providing mechanisms to encourage easy compliance on the part of taxpayers, because now there are simplified rules on how you pay and file your tax return. You can pay it anywhere. And also the changes in the VAT rules and some documentation. And in December of this year, of 2023, the Department of Finance also outlined the following priority tax measures. And this include the real property valuation and assessment reform for a uniform and equitable property valuation, and the value-added tax on non-resident digital service providers, which I explained earlier. Yep. Currently, the Senate version is being routed for approval of the Committee on Ways and Means. And we also have the VAT refund for non-resident tourists. So we can be a shopping destination as well. And we have the Passive Income and Financial Intermediaries Taxation Act. And this one is, it has been approved by the House, but currently being deliberated at the Senate level. We also have the rationalization of the mining fiscal regime, and the Department of Finance is also advocating for the imposition of excise taxes on pre-mixed alcoholic beverages and sweetened beverages. I think so far those are the developments that we have.
Great. Malou, thank you so much for joining me on Global Tax Talk. It's been great to have you here, and I look forward to getting you back again. And thank you for joining us, and come back again so that you stay global tax ready.